Welcome back. In this video, I'm going over what the difference is between itemized deductions and the standard deduction. We'll cover how you know which one to take and what you can take as part of the itemized deduction. So we'll cover all the details in this video. If you've been confused by things like charitable deductions, medical expenses, these things you hear you get to deduct, but then you're not really sure how that works, or you might have been doing your taxes and been asked, do you want to do the itemized or the standard deduction? You've heard these terms around and you're just wondering how they apply to your situation. Plus, I'll be showing you at the end what this looks like in DIY tax software. The tax software that I show you how to use in a bunch of videos is Free Tax USA, and I have the playlist for all of those videos linked in the description below. So if you have a business, self-employed business, single member LLC business, and you want to do your taxes yourself, I have videos that walk you through every step. Be sure to check them out below. If you're new here, my name's Amanda. You're watching The Business Finance Coach, where I simplify all the technicalities of business and money to help you succeed, because I truly believe that you should feel supported by all the structures that we have and not held back or overwhelmed by them. I'm going to be showing you a quarterly tax calculation template that I have for those of you who are self-employed, because we'll be looking at the itemized or standard deduction that I have set up in that spreadsheet template. And that's actually part of a free business spreadsheet template I give away. So check out the description below for details on that. Let's get started with what's the difference between itemized and standard deduction and everything you need to know about how they work. Okay, so we're going to get started, and I'm going to explain, what this is about, how it fits into your taxes, how you choose which one to take, because you only get either or, and where all these options are located. And then we'll go through the details, what is the standard deduction and what are the itemized deductions. So we're just going to take a peek at the 2017 tax form for a moment, and you can see that it's organized really nicely in 2017, so that's why I want to review it here. First, you have all of your income items. Then you have deductions for adjusted gross income. Adjusted gross income is this subtotal on our tax return. So these are some very specific deductions for this subtotal. Be sure to check out another video I have going over every tax write-off, and there's a free checklist that goes with that video, so check that out. I'm not going into details for other write-offs in this video, just the itemized versus standard deduction. And so if we go to page 2, this is where we are approaching taxable income. You can see taxable income here at line 43. But before that, after our adjusted gross income, we have a few specific deductions that bring us to taxable income. So that's where this deduction is situated. And you can see here on line 40, it says itemized deductions from Schedule A or standard deduction. So we only get either or. If we flip over to 2019, one ridiculous thing that the Tax Cuts and Jobs Act did is they changed the tax form from a 2-page form to an 8-page form. So now you can see we have less lines that have been moved to schedules. But regardless, we can see here on line 9, standard deduction or itemized deduction. There it is again. And so I just show you the 2017 version because it's a little easier to see, because we haven't moved some of the lines onto extra schedules. So standard or itemized. Now, if we take a peek into the left corner here, we see what the standard deduction is. It changes slightly every year, but it's a set amount based on your filing status. So your filing status is single, married filing joint, head of household, or you could be married filing separate, although it's far less common because it's not advantageous, or qualifying widower. Now, married filing separate is same as single. You can see that here. and qualifying widower is same as married filing joint. So if you're single, the amount is $12,200. If you're married filing joint, it's double. And if you're head of household, it's a little bit in between at $18,350. I'm not going to go over the filing statuses in this video. You can check out a different video for that. But the simple explanation is on the last day of the year, were you single or were you married? Qualifying as head of household gets a little more complicated. But if you are single and taking care of dependent children, maintaining a household, then you can qualify. And there's more rules that go into that. So those are the amounts for the standard deduction. Alternatively, we have itemized deductions, which are from Schedule A. So this is our Schedule A, and you can see there's a bunch of different topics here on the left. So Schedule A is made up of a bunch of different deductions that you may have heard of. And each of these deductions, each section, has a bunch of additional rules. So the result, though, based on your situation, is you're going to have a total amount. Let's say that amount is $5,000. Well, you're definitely going to want to go with the standard deduction because you get to choose the greater amount. And this is very unlike our taxes. Often it's the lesser amount, but this is one of those weird caveats where you get to take the greater standard deduction or itemized deduction. So basically everyone gets to take one, the itemized or the standard, and they get to choose based on whichever is greater. Now there have been some change with the Tax Cuts and Jobs Act of 2017, which in regards to this deduction, it's very confusing. There were many changes and the net effect is certainly, I think, an increase on middle class taxpayers and probably a decrease on upper end taxpayers. And that's because they increased the amounts of the standard deduction. But remember, we just said that you get the greater. So they made it harder to take itemized deductions by making the standard deduction greater. But they took away another deduction that we used to have called personal exemption. So if you see here on line 42 on our 2017 return, we used to have this additional $4,050, and it went up every year, deduction that everyone also got. And so it was easier to qualify for the itemized deductions because the amounts were much lower. You can see here in 2017, a single standard deduction was $6,350. So because the standard deductions almost doubled from 2017 to 2018, it looked like we got a bigger deduction. But many people didn't understand, right, that actually we lost the personal exemption and it's now harder to qualify for the itemized deduction. This is my spreadsheet template that helps people estimate their quarterly taxes, which is basically doing an entire tax return. And so our Schedule A itemized deductions are calculating in here as well. It's a little easier to look at than the Schedule A form. So what is included now in the itemized deductions? We can see that we've limited many parts of the itemized deductions, and we've extended some itemized deduction aspects that really apply to wealthier taxpayers. So let's dive a little deeper into what's included in the itemized deductions. So let's start with number one, which is medical expenses. And of course, medical expenses can be a big category for people, right? This includes health insurance, dental insurance, eyeglass insurance, and then any cost that's diagnosed by a doctor. So let's say we had $20,000 in health, medical, and dental expenses. That's not unheard of. You can see our next line here, we need to enter what is our AGI, that subtotal we went over. Let's say our AGI is $80,000. Well, look at this. Instead of being able to deduct $20,000, we are limited by 7.5% of our AGI, which is $6,000. So we only get to deduct the amount over $6,000. So in that case, it's $14,000. Of course, it's going to be pretty hard for someone at $80,000 in income to be spending $20,000, right, on their itemized deductions, on their medical expenses. So if, let's say, a more realistic amount for someone spending $20,000 would probably be $180,000, right? And so then this deduction is cut down to $6,500. The next area is state and local taxes. And this used to be a really big itemized deduction for people, and now it's limited to $10,000, and that's calculating right here. So let's say you have sales or income tax. So if our income is $180,000, the amounts that were withheld for our state taxes, we actually get to deduct here as an itemized deduction for state and local taxes. So that might be something substantial like $10,000. And then if we own a home, we'd also get to deduct our state and local real estate taxes, which again, those can also be pretty substantial, right? Probably like $8,000. But you see what happens here, instead of us being able to deduct $18,000, we can only deduct $10,000, and our total is right here. And we might have even had more taxes, such as state and local personal property tax, which is like real estate taxes, except on other assets. So you may or may not have something like that. And one thing to note is that you do get to choose between your income tax or a state sales tax. And DIY tax software walk you through that option, but most people, it's more advantageous to do the state income tax if it applies to your state. The next category of itemized deductions is interest you paid, and this is generally mortgage interest on a house. And so the portion of the payments that you make on a mortgage that are for interest, so not principal, they are a deduction here as the itemized deduction. And I've seen some people talking about how, they didn't pay for a house in cash so that they could get this tax deduction. That's a bit silly. You might not want to pay in cash because you're investing the money somewhere else, but it's certainly not going to be worth it just for the tax deduction. There are limitations on the principal value of your home, and you can take the deduction for a personal home as well as one other like vacation home. And it can include for up to $250,000 of a home equity line of credit as well. Our next section, which is really applicable for our wealthy people, is gifts to charity. So cash or check, property donations, and you can have a carryover for amounts that you couldn't deduct in the prior year. And of course, with all of these, there are a lot more specific rules, and the same is true for charity deductions. But in general, they're fairly straightforward. You want to keep documentation that you made a contribution, and you want to be sure that the business you contributed to is a 501c3, and they should be registered in the IRS's charitable organization listing. So let's say we gave $10,000 to charity and cash. We would put that there. And here's the thing, gifts for charity, guess what their limitation is? Their limitation is generally 50% of your AGI. So that would be $90,000 in this case. And that's why I said, although many people might make gifts to charity, they're generally not going to have enough itemized deductions to take any deduction for it. However, when it comes to our wealthy people, they could be putting substantial portions of their income, because they have so much income left over, into charities. Next, we have casualty and theft losses. This is deductible, but it is heavily limited. So if we say we had some damage to our home, it was $25,000 to fix it, then we'd enter that amount here. It does get complicated for calculating that, as all things, so you could look into resources for more information from the IRS, or when you're going through a tax software, they ask you these questions. But the basic idea is, what does it cost to restore the property? And then we have to enter our AGI again, because this is limited. So we'll go ahead and do the $180,000. And so we're going to be limited by 10%, which is $18,000 and $100 per incident. So after that, our $25,000 casualty loss we get to take $6,900. And so you can see we need to have other expenses in here in order to qualify. Lastly, we have our other itemized deductions, and most of these have been deleted, such as unreimbursed employee job expenses. And I don't mind that they got rid of that deduction because I think it was really confusing because again, it was limited like these deductions where it was limited based on 2% of your AGI. But generally people had less unreimbursed business job expenses. So it was just confusing for people to think I can write this off, but then maybe I can't write it off, right? And then they can't plan, and it's just confusing. So I'm very glad that they got rid of that itemized deduction. However, they've kept a deduction for interest expense when purchasing any property that's used for an investment that's taxable. So it's kind of like how you get to take a deduction for mortgage interest on a rental property. You get to take that on Schedule E. If there's any other type of investment, you're going to get to deduct that interest here. And in the past, our total itemized deductions used to be limited in total once your income was over about $150,000. However, they've done away with that limitation. And so now there's no limit, whatever someone's income is, they can end up deducting this. And if someone invests in a substantial amount of property and is paying a substantial amount of interest expense, like $30,000 or $40,000 a year, then they're going to be able to take that deduction as the itemized deduction. Because remember, you get to choose whichever is more, the standard deduction or the itemized deduction. So you should have a good idea if you have any of these itemized deductions. If not, you're going to go ahead and stick with the standard deduction, which this does have a big impact in our taxes. So it's definitely a great deduction to have. And it's the reason that we don't really pay the rates that are part of the, when people think about their tax rate, you don't actually pay that on your income because we get these deductions. And lastly, as promised, I wanted to show you over here in Free Tax USA how you choose between the itemized or standard deduction. And you can see here deductions in credits. So this is where we'll see some of the things we were just talking about. We can see itemized deduction, and here are all those different categories. So what software like this will allow you to do is to put in your amounts and see what your total comes out. And then you can see it says right here, your standard deduction of $12,200 is more than your itemized deductions of $0. Do you want to use the standard deduction since it's larger? And most people would say yes. The only reason you might say no is if you're married filing separate and your spouse is itemizing, because then you have to itemize too, which is another way that married filing separate tends to not be advantageous. And often when I'm helping people, I don't bother entering their donations to charity or their medical expenses because it would take so much time to calculate those amounts and they're not going to matter. We know that they didn't spend more than $12,200 or $24,400 for a married couple. So I hope this helps you save some time if you're aware that you didn't spend that much, so you don't need to wonder if you're missing out on any of these deductions. I hope this explanation is helpful to you. Post any comments or questions that you have down in the comments below this video. I'd love to hear from you. If you enjoyed this video, please give it a like so that YouTube knows, or share it with anyone who you think may need it. And if you're new here, don't forget to subscribe and hit the bell if you'd like to be notified of my future videos as they come out. See you next time. Bye.